Dear investor, Nuvama Private is pleased to present you the latest issue of Investment Strategy Report for March 2023. Let's take a look at key highlights for Feb 2023. The Indian economy grew by 4.4% year-on-year basis during the third quarter of 2022-23 compared to 6.3% growth in the previous quarter. The gap of approximately 7% between real GDP and nominal GDP is reflective of the elevated price pressures. Weaker than expected growth in private consumption and decline in government consumption pulled down the growth. The current account deficit in Q2 financial year 23 was due to the widening of the merchandise trade deficit to $83.5 billion from $63 billion in Q1 financial year 23 and an increase in net outflows from investment income. In the financial account, net foreign direct investment decreased to $6.4 billion from $8.7 billion a year ago. On the India macro side, demand-side recovery shows mixed signals. The offtake in non-food credit growth seems to have peaked out. On the other hand, manufacturing capacity utilization is on a rise, which reflects optimism seeping in manufacturing sector. Quite a few supply-side indicators are also showing signs of recovery. Services PMI increases to a 12-year high and 8 crore industries continue to rise in Feb 23. Inflation stays elevated for developing and developed economies since Russia-Ukraine war broke in February 22. Though developed economies have seen inflation easing, yet it is above the market expectations. Persistent high levels of inflation have prompted the central banks across the globe to keep interest rates elevated. Regarding Indian corporates, Q3 financial year 23 was a mixed bag. Revenue growth was seen moderating for majority of the sectors. PAT growth slowed sharply on account of the moderating revenue and higher input prices, which are affecting the margins. The Indian equity markets witnessed some correction amidst the market volatility. As a result, considering the performance post-second wave of COVID-19, MSCI World Index has started to outperform MSCI India Index. At the current market valuations, our proprietary quantitative model is signaling at underweight allocation to equities, primarily due to yield gap being skewed towards debt allocation. The momentum indicators are suggesting sideways movement, though possibility of correction may not be ruled out. Protracted geopolitical uncertainty and resilient global inflationary pressures, especially in developed economies, have resulted in global economic recovery being subdued. In India, receding credit growth from banking channels and shrinking corporate profitability indicate challenging environment for economic growth going forward. Decelerating private consumption and capital formation may cause the recovery to slow down even further. We continue with underweight stance on equities. In current scenario, it'll be prudent to be underweight on mid and small cap allocation as well. WPI declined in Jan 2023, majorly due to slowdown in prices of both fuel and power and manufactured products. But the WPI was above the market forecast of 4.54%. Retail inflation increased. It is the highest in last 3 months, above market forecasts of 5.9%, and it moved back to above the RBI target of 2% to 6%. Shorter duration rates have repriced significantly due to global market dynamics. In the current scenario, it'll be prudent to start allocating to duration play in multiple tranches, especially towards the longer end of the curve. Our house view is to opportunistically add duration to the fixed income portfolio as we might be at the fag end of the rate hike cycle. RBI may be using tight liquidity as a tool to keep a tab on the inflation without having to increase the interest rates. This also indicates that we may be approaching fag end of the rate hike cycle. Given the stage of rate cycle we are in and given the flatness of the yield curve, we believe this is a good time for investors to start building duration in their portfolios. Core allocation to high-quality, yield-oriented papers is preferred. Investors can consider to lock in the yields as per their requirements with hold-to-maturity perspective. Allocation to duration can be added to multiple tranches. The first tranche can be deployed immediately.